You can choose between one-step and two-step challenges, but which one is actually easier to pass and get payouts? On the surface, one-step challenge look faster but a bit more aggressive on the constraints. Two-step is slower but a bit more forgiving. But there is a deeper question underneath that I haven't seen be brought up anywhere. Does the risk constraints and challenge structure actually change your probability of success? Which one should you actually choose when buying a new challenge? I ran prop firm simulations with the exact same strategy across the two different challenge types on the FTMO prop firm. Let's find out what happened across all of them. Before we get into the results, it's important to define what we're actually comparing. A one-step challenge is a prop firm evaluation where you have a single challenge phase, reach a profit target while staying within strict drawdown limits. If you hit these two conditions, you pass the challenge and reach the funded stage. A two-step challenge though is a challenge type that splits that process into two phases. Phase 1 has a profit target and rules that you need to meet, and once that's completed, you basically move to phase 2, which usually has a lower target but the same drawdown constraints. Instead of asking which one is easier, we're asking how does the same strategy perform when you apply these two different rule sets to it. If we take a look at the simple example like a 10k account structure on the FTMO, in a typical two-step model, you've got a 10% profit target in phase 1 and then a reduced 5% target in phase 2. Across both phases, the risk limits stay basically the same, usually at 5% max daily loss and 10% of the total drawdown. If we compare that to a one-step structure on the same account size, the profit target is still around 10%, but the drawdown gets a bit more difficult, especially on the daily loss limit, which is typically reduced to around 3%, while the total drawdown still sits at 10% max drawdown. So what changes here is basically the balance between time and pressure. So in theory, one step is a bit more aggressive and restrictive on a day-to-day basis, while the two-step challenge is more forgiving per phase, but requires you to repeat the process twice. Now, when it comes to the actual testing, each simulation is tested through multiple layers of metrics. First, we look at individual phase performance, meaning phase 1 and phase 2 separately. This tells us how a strategy behaves during single phases without any progression effects. Then we can look at challenge phase metrics, where the full evaluation structure is simulated from start to finish. So basically phase 1 and phase 2 together as they would occur in a real challenge. We also isolate the funded stage on its own, meaning we remove the evaluation process entirely and just measure how the strategy performs once we actually reach the funded stage. Finally, we run a full end-to-end simulation where the strategy goes through phase 1, phase 2 and then continues all the way into the funded account until it eventually also fails it. On top of that, we also track a monthly and yearly performance breakdown, which includes profit and P&L distribution over time, so we can see how stable its returns are across different market periods. The strategy that we are using for this test is the simple breakout system that I specifically designed to be traded in prop firms. It takes only one trade per day at most, so the frequency is a bit lower than usual, but the idea is to keep drawdown controlled and to prevent over-risking and over-trading during the challenge and funded stages. It's a 1-to-2 risk to reward strategy with a win rate of around 50% across roughly 13 years of historical data, though the win rate is a bit inflated due to the fact that this strategy has a trailing stop to break even once price gets to a 1-to-1 risk to reward ratio, but its edge comes from consistency over time. The profit factor sits at around 1.24, which means it's not dependent on high win rate behavior, and the most important aspect of this strategy is that it remains consistently profitable even after 3 years of live trading it without changing its parameters or rules. Now in practice, it generates about 3 to 4 trades per week, so exposure is limited and the focus is on quality setups rather than trading frequency. This is actually one of the strategies that I personally use across my own portfolio of accounts, mainly because it behaves in a very structured way under prop firm constraints. Now, looking at the simulation setup and how the results were generated, for the one-step challenge, I used a fixed 1% risk per trade during the evaluation phase. This was chosen because the one-step typically has a tighter constraint, especially on the daily drawdown, so keeping risk consistent allows us to isolate the effect of these rules. Once the challenge is passed, the funded stage is treated separately. There is no profit target in the funded stage, but instead the strategy continues with the same 1% risk per trade, and it simply runs over a fixed 14-day payout cycle. If all payout conditions are met within that period, we get a payout. Now, for the two-step challenge type, the structure is handled in the same way in terms of risk. Both phase 1 and phase 2 use a 1% risk per trade, and after passing both phases, the funded stage again follows the same logic. 1 risk per trade, no profit target, and it runs over a 14-day cycle until payout conditions are satisfied. So across both challenge types, risk exposure is kept constant. The only thing that changes is the structure of the evaluation itself, not the way the actual strategy is traded. So let's now take a look at the one-step results. Starting with the single phase challenge metrics, the strategy shows a win rate of around 60%. Across these runs, the average duration of the challenge is around 63 days, which already shows that even when the strategy is profitable, the constraint system stretches out the time to completion significantly. Now, if we isolate the funded stage alone, the behavior becomes much more stable. We see a 97% payout success rate with an average profit per payout of around 2.4%, which is essentially the raw edge of the strategy expressed without any challenge pressure. But the most realistic view is still the full simulation, where the strategy goes through the challenge and then continues into the funded stage under real conditions. Here, the challenge win rate drops slightly to around 50%, meaning half of the attempts successfully pass the evaluation phase. However, once passed, the funded stage performs significantly better, with a payout success rate of around 89%. Across those funded cycles, the strategy produces an average profit per payout of roughly 2.2% and around 8.4 payouts per completed challenge on average, which shows that once the challenge is passed, this strategy tends to perform consistently well over time. Now you can see the individual challenge list here, which helps validate that these aren't any aggregated assumptions. They are the full life cycle simulations of each attempt. We can take a look at the phase 1 only runs, the funded stage alone, the full simulation run, and even a scaling simulation. But if we go into the full simulation runs, we can see the individual runs actually have phase 1 passed and the funded stage also. We also can take a look at the list of payouts that this single simulation produced. Finally, looking at the monthly P&L breakdown, the strategy produces an average monthly return of around 2.8%, with a monthly win rate of approximately 87%, a win-loss ratio of about 3.14%, with a win-loss ratio of about 3.14, indicating that gains are not only consistent but also significantly outweigh losses over time. Let's now take a look at the two-step example, starting with the single phase metrics again. Phase 1 shows a win rate of around 79%, which already reflects the more extended nature of the evaluation process. Phase 1 also has an average duration of around 84 days, meaning it tends to stretch longer due to the way constraints and progression requirements interact with each other. Phase 2 behaves differently. It shows a higher win rate of around 86%, but with a much shorter average duration of around 42 days, which is expected since this phase is typically closer to the payout transition and has a reduced profit target of 5% against 8% on the phase 1. When we combine both phases into the full challenge, the overall challenge win rate comes in at around 68%, with an average challenge duration of around 117 days. If we isolate the funded stage only, the system becomes significantly more stable again. Here we see a payout success of around 99%, with an average profit per payout of 1.9%. This is slightly lower per payout compared to the one-step model, but notably more consistent. Looking at the full life cycle simulation, meaning phase 1, phase 2 and then the funded stage, the challenge success sits at around 47% with a payout win rate of around 95%. Across these funded cycles, the strategy generates an average profit per payout of 2% and produces around 20 payouts per completed challenge, which is significantly higher in frequency compared to the one-step structure. You can also see here the individual phase progression visually, showing how challenges move through phase 1 into phase 2 before reaching the funded status, which helps validate again the consistency of the simulation logic. Finally, the monthly performance breakdown shows an average monthly return of around 3%, with a monthly win rate of 92% and a win-loss ratio of approximately 3.2, which indicates slightly higher consistency in monthly outcomes compared to the one-step model, even though per payout returns are lower. So when we put these two challenge structures side by side, some interesting differences start to emerge. Looking purely at the challenge phases in isolation, the two-step structure appears significantly easier to pass. Phase 1 achieves a win rate of 79% and phase 2 reaches 86%, compared to only 60% for the one-step challenge. This isn't particularly surprising given the higher daily loss allowance and the lower profit target in the second phase. However, that higher pass rate comes at the cost of time. The average one-step challenge takes around 63 days to complete, where the full two-step process takes roughly 170 days, almost double. In other words, the two-step structure is considerably more forgiving, but it also keeps capital tied up for much longer before reaching a funded account. The one-step model achieves a 97% payout success rate, while the two-step model reaches 99%. This tells us that once challenge pressure is removed, the strategy itself is highly stable regardless of the evaluation structure used to reach funding. So basically the actual challenge phase doesn't matter that much when the account actually reaches the funded stage, obviously. The more interesting comparison comes from the actual full life cycle simulations. The one-step model converts approximately 50% of challenge attempts into actually funded accounts, while the two-step model converts around 47%. Despite the much higher phase pass rates in the two-step evaluation, the requirements to successfully complete both phases offsets much of that advantage. Where the two-step structure really separates itself is after funding. The payout win rate increases from 89% in the one-step model to 95% in the two-step model, and the average number of payouts per completed challenge jumps from 8.4 to approximately 20 payouts. But again, this might be overinflated by the number of challenges sample from the two-phase against the one-phase challenge types. Since the two-phase challenges have a lot less actual challenge sample, you can see that in the full simulation the two-step model had 15 challenges where the one-step model had 30. The monthly statistics reinforce our previous observations, since the two-step model produces a slightly higher average monthly return, a higher monthly win rate, and a slightly stronger win-loss ratio. The differences aren't that dramatic, but they consistently favor the two-step structure. So the conclusion isn't that one challenge type is universally better than the other, but the one-step model reaches funding faster and generates higher profits per payout, but it does so with a lower payout success rate and fewer total payouts over the lifetime of a funded account. The two-step model requires more patience and a substantially longer evaluation period, but once funding is achieved, it appears to produce more stable and longer-lasting funded accounts, even though I believe this is just a matter of actually having less simulated challenge samples. Overall, the choice ultimately comes down to whether you value speed of progression and actually passing challenges or long-term funded account stability. What can we take away from all of this? At the beginning of the video, we asked two questions. Which challenge structure is easier, and does the structure itself actually change your odds of success? Based on these simulations, the answer is yes. The structure actually matters. The one-step challenge gets you to a funded account faster. The evaluation period is much shorter and the profit per payout is slightly higher, and you only have a single phase to complete. The trade-off is that the tighter constraints create more pressure during the evaluation process and appear to reduce long-term funded account stability. The two-step challenge takes considerably longer to complete, but once funded, the results suggest a greater consistency. What's particularly interesting is that these results come from the exact same strategy with the exact same risk management and the exact same market conditions. The only thing that changed was the actual evaluation structure surrounding the trading strategy, and that's probably the biggest lesson from this analysis. Of course, this is only one strategy, and different strategies may react very differently to these same constraints depending on their own rules, which is why I'd be interested in testing additional strategy types in future videos and simulations. Now, if you'd like to see more comparisons like this, let me know what challenge structures, farms, or even strategy types you'd like to see tested next. Thanks for watching, and I'll see you in the next one.